what is reaction versus anticipatory? Anticipatory is knowing, for instance, like I gave back here, when we were trading at this candle and this one started, I told you that this was going to be an inversion fair value gap before we even traded up into it and through it. So that's understanding what it is I'm looking for. Unless you have some anticipatory skill set that you've grown and then adopted by keeping journal entries and screenshots. Take lots of screenshots. They're free. Dress them all up, put all kinds of lipstick on your chart, and all these empty spaces over here and over here and up here and over here. That's where you write down your annotations, your inner musings, the things that you think are pertinent to you right then and there, where it's safe to do it. This is where you want to make those mistakes. You want to be able to see these things in a very disarmed environment. That means if you don't do something perfectly, there's nobody there to judge you over it. And the worst thing you can do is be the judge of yourself when you're trying to find yourself as a trader and find your model. It's really important you do that, because I hurt myself psychologically, physically, emotionally by doing those things to myself. I talked bad about myself when I was trying to learn this because I expected it to be easy and fast. And that's why I'm such a hardliner about telling you to be patient with yourself, expect it to be longer than it would be otherwise, because everybody has their own baggage. And until you sort that out, and how do you sort that out? By journaling and writing down the things that you're thinking and recording what's going on in your personal life at the same time. Are you arguing? Are you fighting? Are you between jobs? Did you get fired? Are you potentially going to lose your job? Are you sick? Are you fighting an illness? You know, just recently I had to go through that same thing. I wasn't feeling well, and I had to take a huge step away from everybody to get myself well. And I feel wonderful now. But you have to take ownership of it. And you'll see that you are the problem and you are the reason why you succeeded. It's that you went through the process of pruning all the dead branches off of you that's stealing your vitality, your energy, your focus, your health, your attention. All those things need to be pruned. And the only way you do that is discover what they are. Don't let anybody else out there on the internet tell you what your problems are. And I'm not going to be the person to be able to do that either, because you're not going to be honest with me. You could be having an infidelity escapade right now with your spouse. You know, you could be living a double life. I don't know that about you, and you're not going to bring that to the forefront of the conversation if we met. That's what I'm talking about. You have to be 100% honest with yourself about what it is that makes you tick, what makes you think. And you have to include those things at the time when you're doing your journaling. And that's why your journal should never be public record. Never do that, because by your willingness to do that, you're going to keep barriers and boundaries up. And those walls are going to prevent you from being honest with yourself, because you're going to feel like you're obligated to look better than you really are at your present state of development. And it's important that you remember that what you're doing right now is to make that inner trader inside you consistently profitable, yes, but not in a rush to get to that state. It's hard to fight that urge. I wanted it to be fast, and it took for me too. But the easiest way to get there with the shortest timeline is to do everything I'm telling you to do right now. I talked about how the dollar index would obviously use the inversion fair value gap here. And we had some bullish buy side unbalance, sell side efficiency. And then we had another inversion fair value gap here with a suspension block. You can see the imbalance is here. It's not noted like this one is here. I'm not going to draw it out, but you can see it there and there. And then we traded down to consequent encroachment of that suspension block perfectly, ran from that. And then we had this suspension block here, which is a bullish fair value gap with a volume imbalance at the high and the low of it. Look at the bodies respecting the upper half. Yes, we can travel down to the low of it, which it does there. And then we hit the lower quadrant on that candle. The point is this: knowing what makes the market go up, there has to be some underlying premise. What was the premise on the dollar index? This low swept it there. And then we want to look for a low risk entry to a market maker buy model. So what you're saying is anytime that the market enters into a buy program, that means it's going to remain bullish for a length of time until it trades and traverses to an opposing pool of liquidity. What this is it's smart money reversal. Smart money reversal will always be a purge on liquidity, whether it be a market maker sell model, which would be the opposite of this high down to that low, coming all the way back up, traversing right back to that liquidity there. Now, you may not recognize this. You may not see this as a market maker buy model, but that's exactly what it is. They don't have to look perfect textbook, but the mechanisms behind where price is going and why it's going to go there is still remaining constant, meaning there was a willingness for traders to go long here. When market went down below that low here, what was below that low? In terms of liquidity, it would be sell stops, pending orders for two things. First, those individuals that went long or anywhere in here, they're not going to feel safe by putting a stop loss that's real short. They're going to want to go back to this low here because they're going to see that that is what? Well, that was very strong support, because look how the market reacted. No, I want to see it go below it, because what that will do, it will give me immediate feedback on whether or not this was a raid or if it's going to continue going lower. So it gives you a case study. Well, this is a lab experiment every single time you're watching an old high and old low on any time frame. Why do I teach in the lower time frames? Because there's a lot of opportunity for you to do the things I teach and study. And you'll find all the evidence that this stuff works perfectly in your own hands. You don't need me making videos and recording things. So the market probes below that here. So it moves below that low there. So it opened. Look how this candle formed. When the market's reaching below an old low like that, I want to see it travel below it. And by opening above that low being here, this candlestick opened right there. And then at that moment, it starts dropping down to that low. What I'm looking for is, does it trade down below it? Why is that important to me? Because number one, everything that causes the market to rally high and low is always on the basis of a market maker sell or market maker buy model. Every fluctuation in price action could be broken down fractally to that very premise right there. It need not be understood at the beginning of your learning. You're going to grow in your understanding about what that means if you're studying with me. Regardless of what you trade as a model, your entry, your silver bullet model 2022, for instance, model 2022, that is low risk entry. That's the part of the market maker sell model or buy model that you're trading. You may not have ever identified it as such, but that's exactly what that is. Turtle soup. That's the smart money reversal. Maybe you've never known that. Maybe you never identified it as such, but that's what it is. Second stage reaccumulation or second stage redistribution, which is the unicorn of the models. That is the biggest, most explosive, sustained price run that trades to the opposing liquidity of a market maker sell or market maker buy model. But those continuations are simply silver bullet premises applied to that time frame that you're seeing the market maker model on. By having an understanding that the market's going to traverse from buy side to sell side to buy side, and it's going to move from buy program to sell program, by expecting the market to provide you stepping stones, moving from one position to the next, it will free you up of this fear of missing out, which was a huge help to me personally because I had no real model when I first started. I was just winging it. Much of what I say all the time to all of you is you feel like you have to learn it real fast or it's going to go away. You're going to miss the opportunity. And if I was honest with you, I probably wasted more time worrying about that when I was young. The couple times that I made money when I first started, the few times that I made money, it felt too good to be true. And I was afraid it was going to stop working and I would never be able to do it again unless I made all my money really, really fast. And now fast forward 33 years. Looking back, that was such a silly mindset. It's understandable because if you don't come from money, if you don't come from an affluent lifestyle, you feel like you're fighting tooth and nail to get to it. And you have to do it fast because you want to get out of the pain you're in. And that is exasperated and magnified when you're trying to learn to be a trader because it's painful doing it wrong. It's painful not knowing for sure what it is you're doing. It's painful losing money, even if it's $25, $10, $1, getting stopped out and getting the commissions still covered, but not making any money. That's painful in the beginning. You have to find your way in this stuff. But there is a path. There is a way that'll lead you to it, but it's going to require a lot of work. It's going to take a lot of study. It's going to be a lot of filtering on your part. And eventually, when you get to know what it is that you're doing, you're going to filter even me. By having the expectation and anticipating that price will drop down, let's break it down into even a smaller scale. And what I'm saying here is not just applicable to the dollar index, but I'm telling you what you can do with this information. You can scale this to any measure that you want. For someone that wants to take a stab at this and learn how to do it from a less of an intraday perspective, you can do something like this. We know at this day when it opened up on this price, and we know we're real close to that low. So you can do something what I taught is called Purge and Revert. You don't have a way to get in and trade intraday. This candlestick opens right there on that day. So right away, you know that there's a strong potential that the market's going to traverse from that opening price to that low because there's liquidity and it's so close. It's called close proximity. This opening price to that candlestick's low, close proximity. If you were a day trader, what do you think might be beneficial for you in this condition right here? You know it's going to act like a magnet and draw you down to that liquidity because there's orders below that low. What kind of orders? Sell side liquidity. So that sell side liquidity is doing two things. Number one, it's protecting the long holders with their stop loss below that low. Who would do that? There's lots of traders that do that. But maybe there are individuals see that low and they think the dollar index is going to go lower. And maybe they're bearish on dollar. And they think once it goes below that low, they want to sell short on a breakout. Breakout artists selling short on a stop. So there's sell stops protecting long holders or sell stop entry as a mode of entering going short. You can be a buyer or seller on a stop. That means it has to trade to your price. Just like if you're long and you had a sell stop below the marketplace, at, say, for instance, 50 cents. As soon as it trades at 50 cents, it's going to activate that order to be a market order to sell at market. Then there's limit orders where you can buy or sell on a limit. That means it has to trade to your price or better. If you were short already, or if you're going short at the open, reaching down to that low, this low price comes in at 96.377. So if you put a limit order to buy it back, you would be putting an order at 96.376. Me personally, I would put it right at that low because I want to make sure that even if it just touches one tick below it, chances are I'm probably going to get that fill. And you can see it doesn't spend too much time down there. So as a day trader, when you see the daily chart, which is again what I teach many times, you want to look for these pools of liquidity, these draws on liquidity on the daily chart in the direction that the monthly and weekly instigate. Where is it really moving? Where's the strongest tide pulling us on that monthly and weekly chart? And there isn't a whole lot of changing of that tide. It stays in place for a while. As a Forex trader, the day that it opened up right here on the dollar index, you know that what's the dollar going to do? Strong likelihood that it's going to traverse intraday during this daily candle. It's going to trade down to that low. And the way I teach, it's going to reach below that low because there's liquidity below it. Now, as a scalper, as an intraday trader, for Forex, if dollar's going down to that low, that means you have short-term scalps that you can go long on euro and pound dollar, Aussie dollar. Anything with the dollar index second in the name of the pair. Now you have a real quick way of being able to go back and study things on your own charts. This same premise, if it opened, say this is an hourly chart, not a daily chart, okay? And we're real close to that low. The hourly candlestick would be opening here. You know that it's likely to do what? Strong likelihood that it's going to want to drop down to that low. It matters not what time frame you're trading on. It's the same idea, same thing being applied. Now we're going to apply a different mode of thinking with the same underlying market conditions. Now, think about what we've done here. Close proximity to liquidity on a daily chart. That means intraday, the market's going to trade down to that low. If you're using intermarket relationships and it's the dollar index that you're doing the analysis on, it's likely to do something like this. That means that the Forex pairs that have the dollar index in the second name, for instance, the dollar's going to go down, pound dollar, euro dollar, Aussie dollar. So that means the pairs that have the US dollar second in its name, when it's opening here on the dollar and it's going to drop down into that low and below it. When it does that, these types of currencies in Forex are going to go up until the liquidity below that low here is taken. Then the easiest low-hanging fruit objective for you is to sell your euro long, pound dollar long, Aussie dollar long. For currency pairs that have the dollar index in the front of the name, they will do the same thing. They will mirror what the dollar index will do. So there'll be some kind of a low that they're reaching for too. This very important. Please don't miss this point, okay? When you're trading with positive correlated Forex pairs with the dollar index and your analysis is being framed on the dollar index all the time in Forex, always. If you're not trading with the dollar-based idea, you are trading blind. We're in close proximity of this low for dollar. It's going to likely draw down to that. Dollar yen, dollar Swissy, they're going to drop too. But the low that may be also something that you're aiming for relatively, there might be a low on the dollar yen or the dollar Swissy, comparably at that low, but it may not take that low. How could that possibly happen? If the dollar's going to take its low, why wouldn't the dollar yen and the dollar Swissy take its low? SMT. Now, right there, that has cleared a whole lot of cobwebs for some of you out there because you think everything should be 1, 2, 3, ABC. The rules never deviate. There's never any kind of departure from what you think versus what the realities in the marketplace is. So having the analysis anchored to the dollar, that means when this low is taken there, that is when you close your short on any pair that starts with the dollar in the front of the name of the pair. Remember, these up here with the dollar index to the right, there's a second name in the title of the pair, they're going to be moving the opposite direction. So very, very important. You have to keep in perspective what the dollar's doing because if this thing's going to move, it's going to affect the currency pairs that you're trading. And SMT, which is a divergence. And visually, that's essentially what we're expecting in dollar. That low, this low piercing that low. That's the old low. This is the low we anticipate forming below the previous one. That's this visually here. But we may see a low in the dollar yen and it's getting real close to it, but it may not go all the way below. It might go right just above it and then pull away. And then you have the dollar Swissy. It might agree and go that slightly lower low. But what do we have? We have a divergence in positively correlated currencies. Dollar index based with the dollar in the front of the name with the dollar index itself that we're showing here in chart form. This is what we anticipate in dollar. This is the reality. With yen, it says, no, I'm not going to go lower. And this here does go lower. If this happens, that could be indicative of a shift in internals that's going to support or cause a larger magnitude reversal mindset on the dollar index, because big money, remember I was telling you earlier, they don't have the benefit of going into the marketplace on a very small short-term time frame, because they're trying to hide what it is they're doing, and they also have to use the available liquidity that's available in the marketplace. All the price action that took place in that 1 minute or 5 minute candle isn't enough for all of these banks globally to shove all their orders in on that one candlestick. But what they're doing is accumulating the sell stops below here, and then they're buying more at that opening price. So the opening price here, when price goes down below that, if you're a working class hero, you don't need an intraday chart. You can have the same expectation and anticipate that they're going to drop from that opening price down there. But if you anticipate that price opening on that candle, get the opening price, see when we're in close proximity, like as soon as they close here like that, okay, wonderful. Then wait for the new candle for the daily chart to open up, get the opening price. Then you know that it's likely to traverse and go down to that low, and you want to see it trade below it. As soon as it gives you this information, you already know that you can have a buy stop. You don't have to be in front of your charts. It's on autopilot. You can apply this to index futures. You can try to trade it with Forex pairs. You can do it with stocks. You can do it with commodities, bonds. The idea is that once it does this, you're not in front of the charts when it's doing this. You don't need to be. As soon as it comes right back up and hits that opening price again, if you are right about the ideas that you think that it's going to go down here and take the liquidity and then start the run on a smart money reversal basis, are you getting long down here at the low on turtle soup? Nope. Do you need it? Nope. Because your idea is it's going to go up to where is the draw after smart money reversal. What you do is you want to take your high down to the low that formed intraday, and it comes back to that opening price. As soon as it comes back to the opening price and trades one tick above it, you're immediately inside of a new buy program. So this is kind of like a little play on words with order block theory. It's the reverse. Yeah, how about that? This opening price on that candlestick, as soon as it hits that, you can be long. But inside of this, here we have the high, and this would be the original consolidation, or where the draw would be on a perfect market maker buy model. Market's going to go up here. But in your infancy as a developing trader, you don't hold to that idea all the time. You have to have a low-hanging fruit objective. What would that be? 3/4 of the move, or optimal trade entry. You know that a market maker buy model and a market maker sell model does not have to go all the way back to the original consolidation or opposing liquidity. That's just the best case scenario. Now, they're not an absolute. They're not a panacea. They're not a be-all, end-all. It's going to only happen this way like you think it should as a new trader. New traders think that way. It has to work like this all the time, or I don't want nothing to do with it. Go do something else, because that's not what the market's going to do. I promise you, in the first 3 years of your trading, you're going to find out that you are probably 90% wrong about what you think's going to happen, and any money you make in the first 3 years is just happenstance. You aren't really equipped to be consistently profitable. Even if you are profitable, the first 3 years, you're floundering. You're going to discover so many things past that third year. So if you're in a hurry to get profitable in the first couple months or the first year, settle down. This is a lifestyle. It is not a lottery win mentality where you go and now you suddenly have to make money all the time. You're going to learn so much about yourself. And it's good that it's this way, because you're going to be much more mature as a trader. Low-hanging fruit objective would be reaching up to 70.5, which is the sweet spot or optimal trade entry between 68-79% retracement levels. That was the flagship pattern that I started teaching. But its foundation finds its way in every facet of my trading. This is low-hanging fruit. This is all you would require getting up to from that low. You don't need it to go up to here, but it still can. Now, working class hero, as soon as it opens and it trades down below here, what you can do is put a good till cancel buy stop. As soon as that low gets taken out, you put a good till canceled buy stop in your paper trading account. When it trades there, then you use that low as your stop, or maybe a little bit below it, because you just want to have no concern about it. Once it fills, your objective is to aim for that 70.5 level. That's your working class hero model. You're trading the same things that we're trading with intraday charts. You're using very specific criteria. You're not willy-nillying and worrying about what's fair value gap to buy. You're not worried about what order block to buy. It's a very static price entry. This model can be used on any time frame. Don't think that this is the only way to use this because it's a working class hero and this is how you use it on a daily chart. You can do this on 1 minute charts. You can do it on a 15-second chart, a 5-second chart. Okay, we're going to have a huge paradigm shift right here. But you don't need to be a market maker buy model or sell model trader. We don't demand that it goes coast to coast from down here where deep sell side is all the way back up to the buy side, which I told you it could potentially reach for, but I told you specifically we're going to aim inside this inefficiency. That's where I took your focus in here on this inefficiency. Why did I focus there and didn't press hard about that one? Because I just taught you, practicing what I preach. The easiest draw, low-hanging fruit, if you're trading a market maker buy model, is 70.5 of the range. What is the range? What is the dealing range? How you frame market maker buy model or sell model. Here's the high, and that's the low it's going to trade down to. Why? It's going to go there. From that low, once it trades there or through it, when it creates that low and comes back up to that candlestick that trades down to the low, that opening price is very, very crucial. Very crucial. It is a PD array. I'm not going to reveal its name, but that function frames the whole basis of returning back inside the range. And that range is this. That's the range. I don't need it to trade outside of the range high here to be profitable. I mean, what happens if you just traded to this high here for minor buy side? Why is it minor buy side? Because it's not even at 70.5 of the full range that's here from here down to there. That's a dealing range. The market has dealt in between here. So if it goes back up inside that range, you're doing the same thing. You're dealing inside that range. So you're trading inside that range. That means you need to know what you're looking for. Where is there an easy draw on liquidity? If you're using this model here, 70.5 is way up here, right at that high. What would be easy objective, low hanging fruit objective for you? Well, what's the first swing high from that low? Bang, right there. That would be your draw to initially. Also, you can blend it with Purge and Revert, where it runs down, takes out the low, which is a smart money reversal premise. Okay. A premise is not a narrative. Premise is it's probably going to do this. It means what? Go up or down once it goes to that level. That's not bias. That's not narrative. Narrative is price is going to go down below that low because there's sell side. That's narrative. It's going to go down there. And then now you start using a bias. Once it does that, I'm bullish. You see the difference between all those things? They're not the same thing. If you are subscribing to that view, if you place a 40-day or 18-day exponential moving average on the time frame you're looking to trade, that will be the best trend line for you. So stop worrying about what high and low to anchor to. There it is. Purge and Revert could be your complete model if you're outside of intraday charts. Purge and Revert is the high after a low's been taken, go back 3 days, whatever that high is, that's the liquidity it's going to run back to. It's high probability, short-term, basically algorithmic trading. There's many algorithms that fire on that same premise that this is what I'm looking for, and I'm done. They're not aiming for 70.5. They're not aiming for the full run up in here. That's a best case scenario. Purge and Revert is a very short little run to opposing liquidity, and you don't need a whole lot of the run inside of the dealing range to get to profitability for your setups. When we're looking for prices to move higher, we are entering or should have entered a buy program. As soon as price gets it back above this opening price, that's essentially what we're doing. So from that point here, from that here all the way up to that high right here. Now, why am I picking this high right there? Because that's the 70.5 measurement from that high down to that low that formed. So that's the low hanging fruit objective for market maker buy model. Before you get to that, you can use Purge and Revert, which is the high 3 days back from when the low was taken. And there it is right there. So you don't even need this. From this point here to that opening price, that is the core of your buy program. That means every facet, my market maker buy model and sell model, all of the pertinent details for entering it are going to exist inside that range. What do I mean by that? That's that range just being projected to the buy side of the curve. What does that mean? So the buy side of a market maker model, okay, market maker model is the down to go up. Okay, this is smart money reversal. The low is the smart money reversal that takes out opposing liquidity. And we enter right on this candlestick's opening price. We enter the actual buy program up to 70.5 of the previous trading dealing range, which is that high, which is the highest high it was prior to it dropping down to that low. That's all we're doing. That's why I'm picking this high. It was very reactionary, impulsive. It dropped aggressively. There's a lot of momentum away from that high, and it's easy to frame it. That's an easy high, and that's the low we anticipated forming. And as soon as that candlestick trades back above the opening price of this candlestick, then we entered, technically, we're now in a buy program. That means the market is now bullish order flow because now everything's going to march to this Pied Piper's tune. And these candlesticks march to that. Don't believe me? Watch. Inversion fair value gap that was called before it formed. Trades above it. That closed right here above the inversion fair value gap. There's a small little imbalance in here. Volume imbalance. So yeah, incorporate that. That closed right there. Bang. Validates it will be an inversion fair value gap. So we'll let it run a little bit. Just like your pet is going to run until it gets to the end of the leash, and it's going to come right back, bang, right back down to consequent encroachment. Trades right down to that midpoint of that inversion fair value gap perfectly. Then it rips and roars to purge and revert, rallies beautifully. In the process, it creates what? Buy side unbalanced, sell side inefficiency, and a bullish fair value gap. Two down closed candles inside of the inversion fair value gap and the displacement higher, that opening price right there. It's consecutive down closed candles. That opening price, draw that out in time. It's using that, but incorporates the entire buy side unbalanced, sell side inefficiency. So if you were going to go long and you were looking on the basis of smart money reversal entry, it's always a turtle soup of a market maker buy or sell model. When we have the market enter into the actual buy program, once you are in the part of the market maker buy model, you want to encapsulate where my stuff is going to form. Not when. Where is it going to form? It's inside of the previous daily range, high and low of a market maker buy model, and you have to find the 70.5 level of that range, which is what we already identified, and it happens to be just right at that high right there. Inside of this range, all I'm shading here is the same range from that opening price. Once we ran through that low and it came back to that opening price and went higher, that's validating that that was a stop hunt. If everything is true, when we're looking at things that derive the outcome that we're hoping for being profitable, if we're going long, we need to know where we're going to enter and how will the underlying order flow prove to you that it's bullish. Here, we're inside of a range that has the high probability of sending price higher to the 70.5 level. And now we're going to be looking for footholds. We want to climb this rock surface up to this high. From this low right here at that opening price, we believe it's going to start gravitating towards that high because it's 70.5 of this entire range. The bottom line is you're going to look for all of my PD arrays to form. Whether you like one special one over another, it doesn't matter. You need to equip yourself with month 4 content of my 2016 mentorship playlist. By having an overview of the PD arrays that I shared, it gives you a well-rounded base that if you just know those generally, be familiar with them, you will be able to ferret out everything that's in my chart right here. Everything that's right here is taught in my 2016 mentorship, 2017 playlist. It's there. And I used it with you when making these annotations and telling you where the market was going to go. And look where it went. And look where it's at right now after going there. The buy side here, perfect. Ran it. Now what's it doing? Those turtle soup buyers on a breakout are getting souped. What do you think this is from here to there? It's the opposite of what we're outlining from here to there. It's a market maker sell model. The thing that you're looking for in price, that's your fractal. Think of a fractal as your cookie cutter, that thing that you press into the dough that shapes every cookie the same way. But no matter how rigid and how perfect and expensive that cookie cutter is that you went and bought, you press it into a dough ball, not every single one of those cookies is going to come out like each one of them. There's going to be slight little deviations. Sometimes the dough will still grab because you didn't press down hard enough. That means you didn't buy enough. You didn't short enough. Sometimes you'll pull it out and you have to reball it up and smooth it out. Well, that's a stop out. Do another one. You're not throwing the cookie cutter away because it didn't come out uniform like the last 6 one. We have the buy side unbalanced, sell side inefficiency and order block here. It trades down into it here. Now the wick is allowed to do the damage. The bodies are allowed to stay in the upper half of a inefficiency that I call as a fair value gap. The wicks are allowed to do the damage. That means they can traverse down below the midpoint of that fair value gap. The fair value gap is this candlestick high, this candlestick's low. Dividing that in half, so if we're looking at an inefficiency or a wick, it's always called consequent encroachment. Consequent encroachment is the midpoint of an inefficiency or gap. If it is a candlestick like this one here, or these two, that's a bullish order block. The middle of that is called mean threshold. Same underlying premise. It's a midpoint of a distinguished range of price action. The two disparaging classifications is one's a inefficiency or gap, and then the other is a delivered range. It's one candlestick or consecutive candlesticks that comprise a order block. Order block theory is mean threshold for halfway points. Anything other than an order block, it's going to be an inefficiency or gap. That means consequent encroachment. So it's supporting bullish order flow because the bodies are allowed to go down to the low, below that midpoint of this gap, but it doesn't close below the midpoint. You see that? So every single time it does this, boom, this wick drops down and gets real close to this candlestick's high. Now, when it's bullish, what did I teach you? Does it touch it? No, it doesn't touch it. That's what I want. And this level here, consequent encroachment, it wicks down through it. Now, as soon as it creates that wick down here and it doesn't completely close in and comes right back up here, I already know at that point that order flow is absolutely still bullish because this didn't deliver all the way down to where it could have and it closed up there. So now I'm expecting what? We got a new wick. What do you do with that? You measure it. Order flow is bullish. We're inside of a buy program. It's going higher. The dollar index has this wick and we're bullish. The next candle opens right there. Now watch. It's at some point after that opening, it's trading down to the upper quadrant. It's permissible. And then it trades down to consequent encroachment. That's permissible. We do not want to see the body left underneath that level right here. But can it trade to there? The mid quadrant of that wick. This is the fair value gap, consequent encroachment. That's reasonable. It's expected to do that, but we don't want to see the body left underneath that. Same approach and application of the actual wick, which is this open down to that low. That's the midpoint of that wick right here. Can it trade down to that and it be permissible? Yes. We do not want to see the bodies left once the candle closes. It cannot do that. If it does that, guess what that means? You cut half the trade or close it if you're already long. You're talking about trade management for free. But when I'm long and I use this strategy, where do I place my stop loss? You wait for this. This wick that's diving down, where everybody else would be freaking out thinking, oh no, the dollar index is going to crash. It opened here and now it's trading down. It's getting ready to take out that low. The hell it is. No, it's not. It's just redelivering and filling the numbers. What numbers are you talking about, ICT? There's your lower quadrant. That's as far as you want it to go. Candlestick opens up here. We got a wick again. Oh no, what are we going to do now? It's trading down. Look where it went. Yeah, look where it didn't go. It didn't get down the consequent encroachment of that bullish fair value gap. That's a good thing. That's a real good thing. New wick, new range. Order flows bullish. Rules to this stuff, folks. Main one, there's an hierarchy. You're inside of this PD array on the daily chart. This is a bullish fair value gap. It can traverse down in the lower half, only wicks. But as soon as we place one down here like that, we have now limited the order flow in a way where we can see what's permissible and what's not. The next one opens up and trades down, goes right to the lower quadrant, only to the tick. New wick, graded. Consequent encroachment of the wick and consequent encroachment of the bullish fair value gap. It fails to touch the consequent encroachment of the bullish fair value gap and trades to the consequent encroachment of this new wick, which is the range. We have to measure that. So what intel is it giving you as soon as that close right there happens? It's bullish. It's real bullish. Why? Couldn't get down to the low to close it up. Then we get another wick, drops down perfectly to the tick. What it creates this close of this candlestick right there. Where in price action do we have another supporting event? It supports that we have now staged another rallying point. What do you see here? Right when this candlestick closes, what's in place in price action? This candlestick's low, and now this candlestick's higher. So this is a swing low. Anything at this candlestick's open to low is a good buy. It's a discount. And then we open up on a new week up here. This is all bullish price action inside this little trading range. So to recant what it is I'm talking about here, we have smart money reversal, which is always a turtle soup premise, it's a false breakout. Low risk buy is always inversion fair value gap if it offers it to you, which is this here. If there is no fair value gap over here, this smart money reversal forms the very first bullish fair value gap that forms. That is your low risk buy. If it's reversed, it's going to be your low risk sell. Always! The next fair value gap, it has to have an order block, fair value gap. First stage, accumulation, low hanging fruit, 70.5, and that buy side, and that inefficiency I told you about in September and October. It delivered to it perfectly. Here comes your unicorn, the biggest run, the strongest run in a market maker buy or sell model. Here it comes, ready? Well, look at that. Inefficiency, split it in half, beautiful. Once it clips it, does it close inside this inefficiency? No, it closes up here. You as a trader are going to go short Forex pairs like pound dollar, euro dollar, Aussie dollar when it's trading right in here because the dollar is going to go higher and it's going to reach for that buy side liquidity right there and then up here. Second stage reaccumulation, the unicorn. Obviously, we're looking at this liquidity in here, but we have to measure if this is a market maker sell model in here because this run to that liquidity we talked about back in September, October, it's hit it. Now we've pulled back. Using that same logic, we have this low, which is going to be perfect textbook market maker sell model draw on liquidity. Do we require perfect? No. So how do you classify low hanging fruit? The easiest level it's going to get to in the market maker sell model. But here's 70.5. That means it's the low up to this high. That's the low hanging fruit. So in other words, up here, the retracement back in here, which is reasonable, would be this level here. We've done that. Now, if we close below it, it indicates that we're likely to dig into this eventually. Doesn't mean it's going to be a straight shot. It just means that I would trust that it's likely to continue doing that. And I taught you how to make models, how to use parts of a market maker buy and sell model as your fractal. What does that mean? If you're a turtle soup trader, you're using smart money reversals as your entry mechanism. The low risk entry, that is a inversion fair value gap or first presented fair value gap after the turn or the curve begins. It's one or the other. If there's an inversion fair value gap there, you use that one. If it's not there, you're going to take the very first fair value gap, and that's going to be your low risk entry. Or you're waiting for first stage accumulation or distribution. If you see that form and you missed it, or if you really want ammunition behind your next setup, wait for it to deliver. Let it pan out. And then the first retracing back down into the inefficiency is going to be second stage reaccumulation in a market maker buy model. That's the unicorn. That's the big bang for your buck. That's the setup that just goes off to the races. It's so fun. It doesn't wait around. It doesn't delay. It's just real quick, and it runs to that liquidity. Each one of those is a fractal part of the market maker or sell or buy model. Each one of them is a component. You need to be aware of all of them if you're going to be using the turtle soup idea of entering at the smart money reversals. Why? Because you will have more conviction behind holding the trade because you know every stage of my market maker model, and you won't be scared when it's retracing against you. You know what it's going to likely do. If there's wicks, grade them. If there's inefficiencies, grade them. Consequent encroachment should be respected. The bodies are allowed to only stay in the upper half of the inefficiencies or gaps or wicks, but they can traverse by their wicks down lower and scare you. If you don't have this logic, you'll get nervous and close trade. But if it drops a body below consequent encroachment of any one of these PD arrays and you hold a position that affords you to do so, cut half the position. Simple. If you entered long here and your stop loss is below the low here, as soon as it creates this swing low here and this candle closes, your stop loss can be brought up right below that low. And now you've locked in whatever that profit would be. Same thing here. Once this creates a swing low and it rallies up, then you can move the stop loss from under here up to there, because second stage reaccumulation on a market maker buy model should ever, never, never be traded back down through once it forms. If it does, you're wrong. You want to be out of it by then. Second stage reaccumulation in a market maker buy model never gets a stop hunt on it. Never. It never does. If it does, you're on the wrong side of the marketplace and you want to be out. I said it twice now, so that way you know. Second stage reaccumulation in market maker buy model never has a stop rate on it. Second stage redistribution of a market maker sell model never has a stop rate on it. Never. It's too one-sided. It's in a hurry. So that way, if you're positioned ahead of it, that means first stage accumulation, low risk entry, or you were fortunate enough to trade turtle soup long, it helps you manage where your stop loss is. And that's many times why you see me put stop losses in places where I know it ain't going to go. All right, so here's the daily chart on the euro dollar. We have this inefficiency here when it took out that low. Sell side, it drops down. That's a smart money reversal. Original buy side here. It drops down and comes right back up. The gap here is a inversion fair value gap. Why? The premise is the market went down to take liquidity. What liquidity? Sell side over here. If this forms, this right here always will behave as an inversion fair value gap. So we have the drop down in here, first fair value gap there. You can buy that. That's institutional order flow entry drill. That drop right here. Rips another one here. Order block, draw that out. Hits it again. All time distortion. And then it rips higher. Buy side and balance, sell side efficiency. Second stage reaccumulation. First stage accumulation. Low risk entry. Smart money reversal, original consolidation, or the opposing buy side liquidity. Hits it. Then it drops down. Okay. High to low, 70.5. Reasonable. Did it go down to it? Yes. Did it go lower? Yes. Where did it go to? That inversion fair value gap that was framed on the basis of this market maker buy model. Now we're in smart money reversal, low risk sell. Inversion fair value gap exists. That's the one you use. Breaks down, imbalance, first stage distribution, second stage redistribution, 70.5. What level below these relative equal loads would you use inversion fair value gap? Boom. And now we're getting a reaction off of that. You see how all these things blend together, not making a whole thesis on one individual candlestick. You have to blend it together. If you want the results I'm showing, you want to blend what I said about the dollar index with the euro here. And you'll be able to see a lot of the things are just a mirror image. Everything's a mirror image of what was called for, and what was delivered in dollar is going to be the mirror opposite on euro dollar. Here's the British pound or cable, and market dropped lower, had a nice little inefficiency there, hit that. This wick, before this candlestick formed, this was the lowest reaching wick. So you want to grade that. And in here, you can see how the bodies were unable to get to the high end of it. They wick through it, something to measure of like time distortion where it can color outside the lines a little bit. But if you're short, you would collapse half your position and look to another future PD array to reestablish that same portion of your trade. No inefficiency here, but we do have a wick. You can grade that if you want, but it breaks lower, trades back up into this, which was inversion. All this stuff here would be anchored to this inversion fair value gap. Consequent encroachment, can't get to it there, can't get to it there, and the bodies are left even outside of that inversion fair value gap. So that is what really, really bearish. And sell sides below here, tanks down into it there. So cable was actually very nice in terms of what it was willing to do and what the difference between that. Why was cable a better short? If you look at the euro dollar, look, get a mental picture of this, and then look at euro. See how tight the declines were? Very stunted. They're not allowed to just really reach out and stretch. It's not given that much opportunity to move lower. It's real tight and stilted. Whereas you go back to cable, it's allowed to rip lower, rip lower, rip lower. All the down close candles are much larger, much more prominent. It's not just simply enough looking at old highs and lows for SMT studies, but it's also if there is no SMT, how much are the individual candlesticks allowed to trade and elongate when you're looking at one directional ideas? For instance, if dollar's bullish, euro and cable should drop. And if there is no identification in SMT, in other words, if you can't ferret that out in price action, then you're forced to only look at the delivery of price. How much are the daily ranges, or if any time frame, what the individual candlesticks are in deference to the direction? For instance, if you're bearish on Forex pairs like euro and cable or pound dollar, while the dollar is bullish, you want to be looking at the down close candles in the two. So if there is no SMT and you can't ferret out which one's the weaker one, just simply look at how much of the ranges are allowed to perform in euro and cable. And the one that has larger, more prominent down close candles, that's indicating that that's a weaker one. So the next sell side opportunity that you can draw down into, use the first premium array that forms and get short there and just ride it out. This inefficiency here had, if left unfilled, new all-time highs were likely. So I would have preferred it not to trade down in here. So because it has done that, we may have a deeper retracement in mind, which is why I was telling you when we were over here, consider taking some profits on gold. And then we went all the way down here. We're inside this inefficiency. Yes, it offered a little bit, but it only went up into this sell side and bounce buy side inefficiency. It wicked through it a little bit, and that was simply using the quadrants here. Can you see and agree that this wick on this candlestick right here is longer than this one? That's why I'm picking this one. And now what's the useful information it's providing? When price was down here, it can trade up into this inefficiency, but if it wants to trade beyond that, now this is what you want to have in your notes for when you're having imbalances like bearish fair value gaps or bullish fair value gaps, even the suspension blocks. If the block is formed on a wick, not a stubby ended candlestick body, and what would that look like? Something like this. That's a stubby ended bottom candle, or it could be the opening and low being the same price. That's not what we're seeing on this candlestick here or this candlestick. You see that? It's a wick on both here and here. What I do is when I'm below that, and if it can trade up into this inefficiency that's it's defined with that volume imbalance, you see that? That's why I'm using that area there. Up to this candlestick's low, that's simply the bearish fair value gap. But if it's formed with wicks, this wick clearly says it's formed on a wick. And then if there's a wick to the left of that, that is in the same range that this is being shared in, this wick is not the importance. This wick is the importance. So you want to grade that, okay? And then this candlestick's upper quadrant level comes in at 4249.9, and the high of that candlestick comes in at 4250. So 1/10 of a point. Then the market goes lower, and then we hit the lower quadrant right here. The high of that candlestick comes in at 4215.1, 4.0. And we're looking at daily ranges, so it's very, very tight on a very highly manipulated market right now at the time. And then price came back down into the range. I preferred if it were going to stay open like this, higher prices and trade back up here. But now because we've traded back in here, that right there immediately removes my initial willingness to want to see higher prices. And I would be more inclined to wait and see if it wants to clear up any of this here. Otherwise, there's nothing in here that it needs to trade back into. No PD arrays of importance that I like. It could hit the order block opening of this candlestick price, which would be this change in state of delivery. That would be the last line of defense. If it were to trade down and close below that, then we're probably looking for, a drop below here for sell side. And there's a small little inefficiency right in here. If it were to do that on an exaggerated basis, it could get down into there. All right, so here's the daily chart of the Dow index. I treat it like the dollar index. I use it as like a barometer for me. As an index trader, I'm predominantly interested in the NASDAQ only because all of its price moves are exaggerated because it's thinner than the S&P. S&P, big boy. There's a whole lot of stocks in that average versus the 100 that makes up the composite index for NASDAQ. So you have 500 blue chip stocks that make up the S&P 500. So when that moves, it's a better barometer of the breadth of the market. It means how much real buying is taking place can be better measured with the S&P moving up or down in concert with what the idea of bullish or bearish is. Now, with that same idea and thinking, what do you think that would mean for the Dow index? It's only comprised of 30 stocks. One stock could make this average go crazy. One stock can cause it to go way up. And if a few of them out of the 30 go up, it's going to be wildly out of character for the other averages. So that's why I don't trade this one. So if the market does something like this, say we're in a bullish market condition, if this is the Dow in the middle, S&P above it, and the NASDAQ is lower, in the time I'm expecting the market to be bullish, the S&P has more stocks in it than the Dow and the NASDAQ. So by sheer brute force of how many companies that are in the index, if it fails to make that lower low here, while the Dow does make a lower low, and the NASDAQ makes a lower low, this is, by theory, Dow theory, is the basis of SMT. And sometimes it's useful and sometimes it's not. But when the underlying premise is there for the market to be bullish and you get a criteria like this, that really many times signals the low. And that would be basically a turtle soup long below that low for Dow, a turtle soup long below that low for NASDAQ. And this is simply just an optimal trade entry for the S&P. At the time when they all do not agree, when it's already bullish, when this failed low below that low, in other words, this is a divergence between these respective lows. If the S&P is doing this, then we're really bullish. If the premise is underlyingly bullish too. And what would that look like? Remember when I was showing you with the dollar index on the daily chart and I showed you how to frame the dealing range it's in? And then once that low was taken out, we entered this range that is the beginning and framework of a buy program. When everything for my market maker buy model is going to form, all facets of it, the low risk entry, reaccumulation, second stage reaccumulation, all of those are going to be inside that range. Inside that little range of price action, when the buy program should manifest all the facets of a buy model or sell model if it's bearish. If you see this criteria in price action, it further presses the envelope of how fast and how hard it's going to go up, because it's really indicating on all checkpoints that it's going to go up. Now, this is really important. I do not share the same affinity for being wildly bullish if this one is the Dow and this is NASDAQ and this is S&P. If the diverging average is the Dow, I don't care. The greater importance is placed on the S&P most, then the NASDAQ. In a perfect world, every low should be matched with the Dow, the NASDAQ, and the S&P. But there are times when one of those averages diverge. If the divergence like this is forming when you're bullish and this is the S&P, that's kind of like a loaded deal. If it's the NASDAQ, I have affinity for that one, but it would be better if it would have been in the S&P. Sometimes both the S&P and the NASDAQ fail to do that, and the Dow will make that lower low. Right away, let's assume for a moment that we're in some kind of a deeper retracement. And we might be, folks. The Dow looks real clean right there. You see that? The sell side liquidity resting below here, it's validated and qualified as a potential candidate because the low that's anchored here has a higher low to it. So that's how we look at relative equal highs and relative equal lows. The most recent low with relative equal lows, it needs to be higher than the one you're anchored to. Because they're close proximity and same price. The one slightly higher is a validation that this is likely to be attacked at some time. It doesn't mean it's going to be a straight shot right to it. It just means that this is a likely condition that could draw to over time. So it's an intermediate term perspective or analysis. You see this gap right here? That right there, you want to have that on your chart and treat that as inversion. Why? Because we traded down below it. It has passed down through it here and then up here, and now we're down below it. So we have done the work of delivering the absence of buy-side delivery. Now, buy-side delivery is simply the market moving higher from one point to a higher point. Sell side delivery is simply just the market moving from a high point to a lower point, and it leaves bodies across both directions. What does that mean? If this gap is framed with this candlestick's open, this candlestick's close, in essence, this is the range. See, it's got a little bit of a wick here and it's got a little bit of a wick here, but they don't touch. There's no kiss between these two. There's a small little gap. This is a common gap. I didn't invent common gaps, except for I call it a vacuum block, where there's an absence of any real price action there. Zero. This portion of movement here, with this big up close candle, it's inefficient in sell side delivery. It's a buy side imbalance, so it's one-sided up move, but it's deficient in having sell side delivery. So it needs to have what? Sell side delivery, which is a pass back down over top of this range. This portion right in here is an actual absence of both buying and selling. Nobody did any trading between this candlestick's wick high and this candlestick's low. There's a real vacuum of any trading there. This is a liquidity void. It's void of any liquidity because nothing took place there. Because there's no bodies left in these two price points here that I'm framing with the candlesticks closed and candlesticks open there, that right there is a volume imbalance, but it's encapsulating a vacuum block or common gap. So it's really important you understand that. When we saw price drop down and laid the body down over top of this candlestick's close from this candlestick's open. So this opening price and that closing price, that frames the volume imbalance. When the candlestick comes down like this, stops, the next candle opens and stops right there. We have delivered sell side delivery. It offered price on the downside. That is not efficient yet because it has not offered buy side delivery at all yet, because it went this far, stopped, and closed there, and then opened up here. Well, what about the difference between this candlestick's wick high and this candlestick's low? There's nothing in there, and there's no bodies in between the close and the open of that price. It's a volume imbalance. This is sell side delivery. All that has done is turn this volume imbalance into now a sell side imbalance, buy side inefficiency, or SIBI. What? Yes, it's changing its character. What's character? The volume imbalance now becomes a sell side imbalance, buy side inefficiency because it's only sell side offered. What is it lacking? Buy side delivery. When does that come? Here. Candlestick comes inside the range that's shaded here. It closes. The next one opens, trades down a little bit, and comes up here and closes outside of it. So now we have sell side delivery that looks like this. That's sell side delivery. It's the same as a SIBI. The sell side imbalance, buy side inefficiency is lacking what? Buy side delivery. That means it's going to roll that paint roller up the wall here, where it takes it down like this. Well, then you're going to take the same paint roller and roll right back up to make sure the paint is efficiently delivered inside of that volume imbalance right there. And you see it happening right there. So now in this area, what was inefficient on both sides of the equation, buy side and sell side, it became only efficient on buy side because sell side was offered here. So the paint roller was drawn down to put paint from this candlestick's open and that candlestick's close. Then it rolls right back up. So now this whole area has become efficient, but it's an old inefficiency. So if we trade down below it like this, it needs to be viewed as a potential what? Inversion fair value gap, because it can reclaim each one of these positions of inefficiency and the original area over here of inefficiency. If it were to trade up in here, as long as it stays below the midpoint, it could be bearish and send it lower. This low here and this volume imbalance, I like both of them. That might be a little mile marker as well. This area here, you want to shade that and extend it forward because that may act as an inversion level. Once it trades down to it, if it goes down below, it comes back up. You could actually offer an opportunity much in the same way as an inversion fair value gap. It's a change in the character of its original purpose when it was placed in price action. This wick, because it's the lowest of all these, you want to grade that. All right, so here's the high, the upper quadrant, consequent encroachment, the lower quadrant, and the low. So if it's going to go to this level here or trade down into that sell side, wouldn't you want to see a body close below the consequent encroachment? Right, you're learning, see? If it doesn't do that or can't do that, then it's going to require more time, or I'm probably wrong, and it's probably not going to go down here anytime soon. All right, you see the divergence between the two? Let me show you again. See the Dow? Higher, and then we have lower high. And because it's the S&P, not the Dow, the difference is now the S&P said, I'm not interested in making that higher high. When the retail crowd was saying, look how strong the Dow is. Yeah, look how strong it is. Now it's joining. So the divergence between the Dow making a higher high and the S&P not making that higher high, and just for clarity's sake, you can see it again. Dow made a higher high. Seasoned traders were not exasperating about how wonderfully strong the Dow is, like that was anything in terms of bullishness. ES said, I'm not interested in going up there with the 500 companies that I'm tracking, and look how it's performed. What is this? It's a volume imbalance. You want to have that on your chart. If you're an S&P trader, you want to break that down, grade it also. So that's what you would have. And you want to take that and view these levels on a lower time frame chart, and you'll see how the influence is there. Another volume imbalance, you want to have that on your chart. Anytime a volume imbalance occurs on higher time frame dailies, you absolutely want to have that on your chart. This is for your notes. The candlestick here is the low of that volume imbalance. It closed right there. And then the next candle opened up here. So the characteristic is what? Bullish. So if it trades down below it, it's going to act as an inversion if it can come back up and touch it. Same premise here. We closed here and gapped up higher. That's why I'm shading that color. It tells me when price was dropping down. If it trades up into those levels and hits a quadrant level, then you have a little bit of a loaded deal. It could potentially send it lower and reaching into another reference for sell side. So we have a wick in here. You also want to use this one because it's the longest one in all these wicks here in terms of reaching lower. That's how I'm qualifying it. It's not simply the length of the wick. It's how far the wick is reaching lower. This low and that low, what does that form? Relative equal lows, right? So there's a large pool of liquidity resting right there. But because this wick exists, you want to have that graded on your chart. What do you think that the importance of that is? You want to see it not close below this 50% level, consequent encouragement, or do you want to see it trade below that? If this is, in fact, a relative equal low that it's drawing to, if we get through this wick, there should be speed to close below this halfway point of that wick. And if it can close below that, then it really makes it easy that it's going to go here. But you hold on to that idea. I'm not saying that it needs to close below that for the short to be valid. It doesn't mean you have to close below here to be short first. And I'm just saying that these are all qualifiers to build confidence while price is dropping if you're short. These are things that would build the idea that I would be comfortable staying within the trade. And they would all be like confirmations, things that make you sleep better at night while you're in the trade. We'll drop into a 15-minute time frame. So you can see right away, they use that inefficiency I mapped out on the daily chart. Look at the bodies respecting that. That's beautiful. And then we fail to get to it here, and then we leave it. We come back up, hit the high of the old wick on the daily chart, broke lower, bearish fair value gap that lays right close to the upper quadrant of the wick. So order block, upper quadrant, beautiful delivery, breaks lower, trades down to the lower quadrant, the low of the wick, and then reach down here. And then we have the relative equal lows here, and there's the earlier low. So this is high probability, and then it should speed up below that if it's ideal to get down into that sell side. So that's how I would use that information and how I would map out my chart. Alrighty, same idea really. We have a low. This wick is the lower between that one and this one. So you want to grade that. These quadrants would be impactful here. You want to see it close below consequent encroachment. That's ideal for it to potentially run continuously to that low. Sell side is here, and same business over here. We had that volume imbalance. I shaded that. It was white, and I told you how we use that range. It would be indicative of what we do the rest of the week. And then we traded lower. Sell side's been taken here. Next point of interest is the consequent encroachment of that wick that's being highlighted there. So it needs to close below 24,602 to continuously be bearish. That's how I would view it. Just for a 15-minute time frame. Beautiful delivery of consequent encroachment there. Consequent encroachment of that one. Lower quadrant of this sell side there. Really nice. Let's go to the daily chart and look at stocks. How might this be useful for stock trading? I do a portion of teaching in the 2017 portion of the paid mentorship where I talk about stock. This is kind of like a different approach to a lot of the things I talked about there. So in other words, kind of like an amplification. All right, so right away, you can see that this is a heart attack for efficient delivery and price action. And this is one of the things I learned when I was trading Globex as a commodity trader. And Globex would be very, very spotty. The way you clean this up is first look at it. What do you see here? And this is beneficial even if you don't trade stocks. So if you're a commodity trader, you'll see a lot of this. Okay. And I'm going to show you the easy, simple fix. It gives you clarity. Okay. But here's the daily chart, and it's extremely, very spotty. Can you imagine being up here? You went long here, and you're holding up here thinking, wonderful. What just happened? That's a haircut. What do you think happened here? What can one do? You're on a daily chart, number one. So you're going to have to come up. So what would that be? You can do a 2-day chart, a 3-day chart, or you can just jump to the classic weekly chart. Old high, that's buy side liquidity. So it rallies above that. When it makes this run higher, see that right there? Volume imbalance. Look how much cleaner price action gets, and it becomes far more predictable than using that daily chart. Why anybody's trading stocks using a daily chart right now is beyond me. The volatility is off the chain. It's been like that for a while. So you have to have a perspective that's linked to a higher time frame chart. This is where smart money is operating. They're not using daily charts. When you see this volume imbalance, you want to carry these through price action. Sell side deliveries offered. What is it now short on? Buy side delivery. That means price moving back up through this imbalance. So this area here that's highlighted, it's missing both buy side and sell side. Even though that wick is there, there's no bodies in between the opening and closing of that candlestick right there. By having it extended through, you can see sell side is offered there, but now what is it missing? Buy side delivery. It happens here. The candlesticks are laid over top of that. See that? And then now we leave it, we close below it. Take your reference point right back to that layer right there. That's where it's going to trade up to. Smart money's going to go short there. Same thing I just described in the indices, same thing I described in the dollar index, same thing I described in the Forex market. It's the same thing, folks. It's looking for inefficiencies. It's looking for a balanced price range. And that's what a volume imbalance becomes when it sells off and lays bodies over top of it. Now it's only what? A SIBI. Then it becomes fully delivered buy side and sell side delivery when the candlesticks trade back above this range. The paint roller being applied to the upside now efficiently delivers the paint. So now this area is become a balanced price range. So if price can manage to get through it, it's going to be real hard to get back above it. And what do you see here? It opens, wicks through it, not through it entirely, but it can't get to the actual high of it, and then went back down below that opening price. If you can get into it there, that's where you short. Stop above here. Why did it go down here? What is this? Volume imbalance. Now, what is it doing? It's providing sell side delivery. Delivery is the action of applying candlesticks into a range that is inefficient. Sell side delivery is the movement of price action directional going lower and being printed in candlesticks that are moving continuously lower. Once you define an area like this, volume imbalance, that candlestick's closed and that candlestick's opening. That's the inefficiency. As price is dropping down, it's doing what? It's delivering sell side delivery. Once it goes down to the low here and a body is dropped on that low, then if it trades back up, if it makes its way back below and leaves this low again here, this will act as a balanced price range. In other words, it's going to be very stiff, real resistance. This potentially could go lower, and I would like to see this be used as that same catalyst here. Obviously, it would be better if it just kept on going lower. But if it goes below this area here and come back up, it needs to stay in the lower half. It can wick through it, the halfway point. So if it trades below this rectangle area, okay, but when you trade below it, come back up, it needs to only keep the bodies in this portion, the lower half. It can wick up in here, but the bodies need to stay in here. And as long as it does that, and that's, again, assuming that we close below this area. Any new candles that form, if it trades back up in here, I'm not going to freak out. I would expect it to do that and then reach lower. And there's sell side here, here, and here. I love seeing that on social media. That's what I use social media for. That's why I go to live streams. They have these different ideas and schools of thoughts. And usually when they're very opinionated, I love it because it tells me their character is they're going to smart mouth the marketplace when it looks obvious and it's already happened. And when it becomes really sharp, bullish, and they can talk, oh, look, it's going to go to the moon. Look how everybody's losing their rear end because they try to short the Dow, blah, blah, blah. I love that because that's indicating the purest form of market sentiment there is. You're getting a goober that doesn't do anything, and they're responding emotionally to something they probably didn't even profit on. And they want everybody to share in their exuberance about what took place that they made no money on. So you're getting peak delusion. You're getting peak retail perspective for free. And that's why YouTube is wonderful. I'm using their perspective because it's limited to the worst potential opinion about these markets. That's what I'm looking for. I can take that time when technically everything's lined up for the opposite to happen based on what I teach and what I trade with.